Recent losses and meltdowns in the crypto asset sector are not to be taken lightly, nor should the financial damage caused to individuals and institutions alike be brushed aside. The reality is that these losses are real. The second-order effects on the ecosystem are real, and the damage caused to the market sentiment is also very real. Reality tends to be nuanced, however, and alongside the damages, price declines, and high likelihood of liquidations by some major players in the market, there are also powerful lessons being written for those willing to look. Prior to diving into any specific details, it is important to briefly revisit just why crypto assets and crypto markets are unique and differentiated from existing financial structures. At the core of cryptocurrency lies the concepts of decentralization, disintermediation, direct ownership rights, and an immutable record of said ownership rights. Over the last several years, these fundamental traits of blockchain and crypto assets have been overshadowed with the rise of privately issued stablecoins, crypto lending and borrowing exchanges, and the growing prominence of institutional players. These events in and of themselves are not a negative trend and should be viewed as signs of a maturing market. What is a negative trend? And something that unfortunately is being brought to attention of investors and policymakers during the recent painful drawdowns is something that happens when market narratives and storytelling overshadows economic reality. Let's take a look at a few of the lessons that are being taught or possibly relearned by crypto investors right now. But before we start, please like the video and subscribe to the channel for more interesting and new cryptocurrency content in the future. Economics always matters. Glaring obviously in hindsight, but worth repeating given the state of the marketplace. The same laws of economics and markets apply to all financial instruments and organizations. Be it promises of 20% or higher returns in the form of interest payments, token incentives to attract new users and retain current users, or trying to construct a business model while raising capital, while also issuing native tokens to support said business model. The signs of questionable models are the same regardless of the medium of exchange. Supply and demand, and by extension, the pricing of financial instruments, are laws that no organization can escape. Leveraging exciting buzzwords, admittedly common in every industry, is especially poor practice for financial institutions, and even more questionable for instruments that are generally not protected by investor insurance. Investors should always conduct independent research before investing. But there's obfuscation and too good to be true promises for investors that are just red flags and should never be ignored. Native tokens. Simply said, a project or initiative issues a native token, governance token, or some other form of secondary crypto asset alongside the primary product or service offering is no guarantee of a secret sauce that unlocks higher returns, especially when the native or secondary token directly support what is allegedly the primary product or service offering. Properly understanding the mechanics of these relationships is essential. In other words, an organization or protocol simply labeling something as blockchain or crypto related is no excuse for sloppy organization, poor business models, or excessive leverage to generate the promised returns. Crypto quality varies. A trend that has recently seemed to seep into the narrative around blockchain and crypto assets is the idea that this time is different and that crypto assets are universally going to fundamentally change the world. The power of blockchain-based applications and crypto assets should not be discounted, but that does not mean that every new token or coin offering should be heralded as a paradigm-changing event. Crypto assets are just that. Financial instruments and assets, and investments vary wildly in quality. Up until very recently, the sentiment among investors and media has seemingly been to treat every crypto offering as a top-tier investment option. The actuality is far different, and a potential ramification of this recent meltdown might be the re-risking of certain types of crypto assets and crypto projects. Not every investment is a winner, and the risk associated with these investments needs to be clear to market participants. Due diligence is mandatory. Building on the previous point, the importance of due diligence is something that should never be relegated to the proverbial back burner. Crypto assets have been a fast-growing and dynamic asset class for years at this point, and many fortunes have been made, some more recently lost. So it is tempting to treat the sector as unique and different from traditional investments. That is a mistake, with the ramifications of this mistake being laid bare for all to see during the recent drawdown. Newer investors, of which there are many in the crypto space, might not have the experience and expertise to conduct exhaustive due diligence prior to every investment. That said, researching the leadership of project, prior track records of management team members, the promises being made, and whether or not these all make logical sense are good places to start. Put another way, if a possible investment is purportedly performing much better than every other option available, it is even more important to understand why this might be. Generating high returns is the goal of every investor, but that is no reason to give short shrift to understanding what you are investing in. Especially important for institutional investors, including corporate treasurers, balancing the need for returns with fiduciary requirements should always be of paramount importance. Crypto custody is different. Crypto custody is a different matter entirely from the custody offerings and services offered around traditional financial instruments. Linking back to an earlier point, one of the core strengths and aspects of the crypto asset space is the direct ownership of property, or crypto, that is possible. Recent use cases and developments, including some of the recent meltdowns that have been discussed widely, rely on the lending and borrowing of crypto assets, utilizing and leveraging on rehypothecation. While rehypothecation is an embedded feature of the fiat financial system, with all of systemic risks and opportunities that it entails, this is a relatively recent development in the crypto space. The phrase, "not your keys, not your coins," have been proven correct again and again, as both decentralized lending protocols and centralized crypto lending organizations have imposed withdrawal limits and other measures on customers across the globe. When combined with the lack of investor insurance products in the marketplace, these restrictions and limitations placed on customers can and has contributed to price pressures on various crypto assets. Understanding custody rights and potential restrictions that can be imposed on investors by custodians are details that can, during good times, be overlooked, but should always be understood. Crypto markets are no stranger to volatility, and it has returned with a vengeance as macroeconomics headwinds combined with some questionable business practices, leading to specific spectacular failures as well as a broader drawdown in asset prices. Fully acknowledging the pain and damage that such wrenching market dynamics create, there are also lessons to be gleaned for longer-term investors. Experience and maturation are typically the best teachers, and as some of the frothiness and speculation comes out of the crypto market, the sector will be more sustainable and stronger as a result. Hope you guys liked the video. I'll see you in the next one.